Welcome to your CPA's Take on Real Estate. I'm your host, Daniel Roccanti, back again with Kyle Paxton. Today, we're going to talk about distressed properties in today's market. And when you're dealing with real estate, everyone is always talking about distressed properties. It's always a big, big indicator in what real estate is doing and great buying opportunities for anyone looking to buy. I mean, the whole BRRRR movement all came off physical distressed properties. You buy, you renovate, you rent, and then you're refinancing. Today, we're going to talk a little bit more on the commercial side. But what does distressed properties look like in this market? Physical prop distress is, something that's pretty wide and very specific to your property. But what really gets people excited is when more financial, operating, or market distress starts coming up. And we're not seeing anywhere near 2008 levels of distress, but there has been a tick up in distressed properties. And in certain situations, you definitely are wanting to make sure that you're looking at your opportunities here.
Yeah, Daniel, like you said, not quite 2008, right? But we're seeing kind of the distress show up in debt, maturities, recapitalization, very specific property types that we'll get into a little bit more. We've done videos in this series kind of around refinancing, recapitalizations happening a lot in 2026. Finances are getting scrutinized. My conversation with bankers align with that. And so, when we're defining distress, I want to anchor us in, we're talking about kind of all facets: payment default, maturity default, negative cash flow. If you have a broken capital stack, the forced recapitalization, if you're having refinance issues, or just general lender pressure, which we're seeing a lot of. I think really where we want to take this conversation is focusing on where we're seeing the distress, what asset classes we're talking about here, loan sales and property sales, sourcing opportunity, and then risks that our buyers are facing as they're kind of shopping around in 2026.
Yeah, distress can be broadly defined here. And so what we're going to really talk about today is more of that distress of what's happening in today's market.
Yeah.
Okay. And so, like we were saying, it's not 2008 levels, and I don't think you'll ever get there, but it does come in waves. And I do think 2006 offers some opportunities. What we're really looking at here is what are the pressure points? Okay. And one of the bigger pressure points we're seeing right now is really coming to that kind of that capital stack. Okay. Just with kind of the refinancing wave that is coming, with the increase in interest rates, a lot of owners and operators of real estate right now are really having maybe a difficult discussion. Okay. Hey, I have properties. It was doing well. I got to refinance. The numbers aren't working as what they used to work. Or maybe it's operational costs are increasing, rents are staying low or flat. And so there's just a lot of things up here that it's not necessarily this hit in the market and everything is going under foreclosure, but there's a lot of pressure being put on owners right now. And they probably have properties where the numbers are either a lot lower than what they used to be or might not even be working at all. And that's adding pressure onto them. What should I do next? Can I make this property work? Or this is now a conversation of maybe I should offload this property. And anytime you have that kind of pressure, there's opportunities for buyers out there, because I know a lot of people are on the sideline looking, and there is opportunities out there. You just might not be able to be like '08 levels where they were just everywhere. You might have to put a little bit more time and effort in finding these opportunities.
Daniel, to your point, you kind of have that trifecta where you have a high, a lot of the source of this conversation comes with just properties being penciled in a lower rate environment. We have a higher rate environment, rents are lower, costs are increased, kind of creates a perfect storm there. And then we talked about, roughly 20% of borrowers are having to refinance this year in the commercial space. And, add that to those that extended in 2024 and 2025, extensions run out. And you gotta get creative here. That's really setting the environment of what we're talking about that perfect storm, I guess, operating environment that we're seeing in a lot of the markets we pay attention to and across asset classes. let's dive into a little bit where that stress is actually happening. Daniel, what are you seeing? Where should we kind of focus our conversation on where we're seeing the distress appear?
Yeah, so the stress right now, it's kind of like in pockets, all right, across the country. It's not even or anything like that. And the distress sometimes isn't even public. And that's very important to understand. Like public distress, everyone sees it. A lot of real estate right now isn't very public, it's more private distress. And so it takes a little bit more effort to find that distress. So some of the key areas right now where we're seeing distress is that when a property has a commercial mortgage backed security right now, that's a lot of properties that the distress visibility is sooner, just because that is more securitized debt. Its reporting is more transparent, so we're seeing things like that. A lot of commercial real estate, like office and multifamily, are in this space, and so we're just seeing a lot more uptick with delinquencies. But it still depends on the type of property, the location, the sector. There's a lot of things, but there's just an uptick in delinquencies right now with CMBSs. We talked a little bit earlier about maturities coming up with a lot of our loans, and they're having to refinance. So what does this mean for the borrowers who are unable to refinance at the same level, or they're getting extensions, and now their extension is up, and now the lender has to decide, like, all right, what are we doing here? Like, am I going to give you another extension? Or now maybe they're looking to sell, or figuring out other ways, or maybe it's just time where it's like, hey, this deal isn't working anymore, and I need to sell my property. Um, Recapitalization's another one. Okay. If you can't get traditional lending, all right, well, now I have to go back to my investors and ask for more money, or I got to find a creative way to bring in preferred equity or mezzanine debt or capital. And so when that happens, it's a big ask for your investors, and maybe your investors, it's time for them to want to get out. Right. But the ones that you don't hear all the time is the quiet distress. So we talked a lot about loans and financing, but sometimes it's just, all right, owners are the property's not doing as well. So owners have to cut distributions. All right, if I'm not getting as much money, this isn't a good investment. Give me my money back. I want to find a better deal. Okay. You start seeing deferred maintenance. This is a huge one that we see on a lot of properties. The moment the money starts getting tight, well, I'm not willing to go out there and start spending on all my maintenance. So you start seeing deferred maintenance start piling up. But then you just see vendors balances unpaid. You got loan covenants being breached, capital calls investors don't want to pay. There's a lot of quiet distress out there, that's quite not hitting the public, but it is a distress in the market right now that could provide some opportunities.
Daniel, those are very good points. I think the quiet distress is where we really want to pay attention to, because that does bring opportunity, right? And I don't know about you, I can see some quiet distress in my 90-day AR and these asset classes we're talking about. I see some common themes in the 90 plus day AR that I'm sitting on, and um, it's one of those things where to what we talked about, maybe rents are lower than projected, the higher rates are driving, um, amongst all the other economic pressures we have going on, are driving the higher costs. And then you just start seeing some of these things kind of whittle away. And, sometimes we see investors that are just kind of waiting for that public listing to might miss the deal. This is a networking game, right? And real estate is so much of a networking game, and getting in before that public listing hits. To your point before, where a lot of our clients and what we're seeing in the market are really going after creative funding, like being in tune with that and understanding how you fit in that creative funding environment can really give you an advantage as a real estate investor, either looking to increase your portfolio or get in for the first time or whatever that may be. And so it's out there, we're seeing it. Those the quiet distress and the quiet, signs, I guess we're looking for, um, can really kind of give you a leg up in this current environment. Take us a little bit deeper into asset classes. What are we seeing? We've talked about it a couple times. We talked about office and multifamily. You want to take us through office, Daniel, and kind of give us an overview of what you're seeing there?
Yeah, we're gonna go over what asset classes are kind of at the most risk right now for
Yeah.
this stress. But I actually look at it as where are we is the most opportunity.
Look at
You
that.
know, I'm
Glass
looking
half full
at
kind of guy. Let's go.
so it might be a risk for the, potentially the seller, but for buyers, these are
Yeah.
opportunities. And we've talked about these kind of classes a lot, but the first one is always going to be office. Office has always been in a weird space since COVID. It has come back a little bit, but it's always been kind of divided here. Okay. The lower quality office and weaker locations, these just, they don't do well. They remain under pressure. These are going to be ones where there's going to be a lot of distress. Your class A, your beautiful buildings, office buildings with high amenities and things like that, they're performing very well compared to the lower end, more commodity offices. And so I'm seeing this divided market right now, but there's a lot of vacancies. Okay. So you're seeing in 2025, office vacancies went up to about 14%. Okay. Around,
Wow.
average around the country. And so that's a pretty high vacancy for an average. And so, but it really comes down to, all right, what is this actual property? Okay, where is it located? This is a good time to start looking for potential opportunities because, it all depends on your city or your location and what is it? Is downtown thriving? Is it not thriving? Is people moving more out to the suburbs? Is office space moving out to the suburbs? This is the time to find where that gap is of, hey, this property is distressed. Maybe there's a great opportunity there. And office space is one of those areas where there's potentially a lot of opportunities. The second one is multifamily. I feel like anyone in the commercial real estate space, it's always office space and multifamily. Multifamily just comes in waves. Okay. This isn't one of those things where it's like broadly broken or anything, but it's just that a lot of supply came into the market recently in some areas more than others, especially down here in the South in the Sun Belt. A lot of multifamily came in here. And so it comes in waves, and we're at that top wave right now where we overbuilt. Okay. People love multifamily because you got to have somewhere to live. All right. Like office space, we can make cuts if we have to. We can work remote. We can find ways. At the end of the day, we all have to have somewhere to live. We're just in one of those dips right now where, hey, we have a lot of supply. Rents are staying flat or even decreasing a little bit. And so, multifamily, the numbers aren't matching as really well. So you can see a rise in costs like insurance and taxes and things like that. And so multifamily right now is a potential hotspot for distressed properties because we're seeing multifamilies where the occupancy is still like 95%. That's really good
Yeah.
occupancy. The numbers still don't even work. If you can't work at almost full occupancy, then that's a problem. And you're probably looking at a property that's stressed and where maybe the owners are looking to offload this and it might be favorable for you. Some other areas that there's potential retail, it's always been bifurcated. It's another one. A grocery anchored, necessity based center is always good. So if I find a shopping center with a Publix, um, that's always good. Everyone wants those. Those will always do well, just because that's what the world always needs. Some areas like malls, RIP, you guys are great when I was in middle school, but no one's going to malls anymore, right? Outlets, things like that. These are a lot more exposed areas, and we're seeing a lot of delinquencies up to more like the 12% in these kind of areas recently. And so there is potential in the retail market. It's just very bifurcated on what type of retail it is. But there could be some opportunities there for turning it around. And then just high level hospitality is another one that's kind of, all over the place. But when you're dealing with hospitality, it's a completely different than all the other ones because you went from things where we're doing year rents mostly to now we're doing daily rents, right? So the revenue resets quicker, nightly basically. And so you never know where it is. But surprisingly, hotels and things like that, delinquency has been up. And so that also is another area where you can potentially. Um, the last will be industrial. Industrial is doing great for after the pandemic. It's just because of how everything moved back to shipping and things like that. This was where a lot of people put money in. A lot of people were doing it, just like anything else. When everyone starts piling in on one industry,
Yeah.
eventually there becomes opportunity there, and it's still very low, but we are starting to see again an uptick in delinquency back in industrial. It's probably an area where we need to look at, is this being very overbuilt? And again, goes back to, do we have more properties that are outdated, things like that? There might be some actual opportunities in the industrial.
Feels like all of the major retail players have that last mile delivery down, where you order something and you get it in 5 seconds, and that's got to live somewhere. Yeah, to your point, industrial is in pretty good shape. So let's talk about like how these distressed opportunities really come to market. So, we have the kind of the basic property sale, loan sale. I've seen some creative stuff out there. We get all shapes and sizes of real estate investors that we work with at James Moore, and it's really interesting to see how um, uh, the investors approach this type of market. So in this conversation, this is really where tax, accounting, legal structure really matter and have to be aligned, right? Um, and so that's a big part of our value proposition, is making sure that we can, on the front end, have the right structure in place. This is something we talked about at length in these videos, but really making sure that everything's right on the front end, so that the economics of the deal post tax align with what we're actually expecting here. And in the current environment, I talk about a lot that I don't want the tax to drive economic decisions, but the reality is the tax is a big impact right now on real estate. And so it's a big part of the conversation. So in just your basic property sale, I'm not going to spend a lot of time on this. We know how this functions. This is cleaner for most buyers. You acquire the asset, you underwrite the title, the leases, environmental, the operations. You typically have an easier time raising capital with investors. But if you're at the point where the property is available publicly and is publicly marketed, the discount maybe competed away, right? And especially, we talked about the Sun Belt and markets we see very closely, like here in Florida. A lot of eyes on Florida. I talk to real estate investors nationwide that are constantly looking at your Florida, Georgia, Texas. Those are states that come to mind. But if you've got a city in mind, you're probably not the only one, right? And so then buyer comes in on these distressed deals, and the due diligence piece that carries the most weight in this is really taking a look at the deferred maintenance. Often that's a huge spend. Tenant rollover, any unpaid obligations, and then, how has the seller actually been preserving the asset? We talked about before this kind of quiet, um, uh, quiet distresses that you see. Deferred maintenance is a big part of that. Um, Another angle here is looking at kind of the loan sale or a note purchase deal. So in this example, the investor is buying the lender's position, often at a discount. A lot of times that buyer comes in and has influence on the decision making, but not immediate ownership. And then that path to control can take different shapes and sizes, but could require workout negotiations, foreclosure, deed in lieu, bankruptcy court, borrower cooperation. These look very different timeline wise and legal cost wise than just the direct property acquisition. And I think it's important to clarify that the discount to the unpaid principal balance is not the same thing as a discount to the real estate value in itself. Um, Go ahead,
I'd like
Daniel.
to add I'd like to add here. So, I think when people think about buying real estate, they just think, all right, I'm going to buy the property outside. And that's the simplest form of buying real estate. And it will always be the core. But in opportunities, when you're dealing with distressed properties, you really want, open your horizon here and say, all right, is there other opportunities? And buying the actual loan or the note, um, is actually sometimes a really good opportunity. We saw this in '08,
Yeah.
to about 2012. A lot of properties got underwater. And banks don't love foreclosing on properties or any kind of lender. They don't love it because they don't want to deal with the property. That's not their business. They just want you to pay back your loan, right? And so they're willing a lot of times to sell these at a discount because they just want to try and get as much money back as possible. Okay. Especially in a bad economy or something like that. And we're not anywhere near, like I was saying, '08 levels. But when you start seeing the stress, especially on the financing levels, there's opportunities there. But you got to understand what it is. Sometimes just buying a note is very simple. Now you got to pay me, okay? But now you got to realize, like, hey, they're selling it to me for a reason because they're probably not paying it, okay? So this could be a path to maybe foreclosure and actual ownership. So there's some risk there, but also some great opportunities. Early in my career, when I started out, it was right at the kind of the end of the '08 crash. Like it happened, the '08 crash happened when I was in college. Okay. And so when I came out, a lot of my work when I first was starting here at James Moore was dealing with these people went out there and they bought notes.
Yeah.
And then, sometimes they got paid back. Sometimes they foreclose on the properties, and the amount of gains on some of these properties they were able to get. It's a really interesting opportunity that you'd want to make sure you don't overlook, because a lot of times this is a way where you can go in and buy a $30 million property at a huge discount. But it just comes with a different kind of risk here, but you can turn that around and flip it in a couple of years. And I saw that, from people buying notes from '08 to 2012, and then turning around and foreclosing on the property and selling it in 2018 and doubling the amount of money they made, just because they were willing to go that route. And so definitely look at different angles here. It's not always just buying the property. Maybe buying the debt is a better choice for you, because it provides a higher upside.
Absolutely. Thanks for adding that, Daniel. We talked about this before, but I want to get a little deeper on how investors are sourcing opportunities right now. So, I mentioned this before. This is a relationship game, right? It's relationships with those lenders, your special servicers, debt funds, regional banks, broker relationships, attorneys. And then we talked about before, I kind of made a joke about my AR. Property managers see operational distress early. Having property manager relationships can be, a great way to source here. Um, and, leveraging public records and information that you can acquire, especially in the AI age, and doing direct outreach to owners facing maturities or capital calls, can be huge. And there's robust data platforms available all over the real estate space. So leveraging the data you have to then parlay the relationships you have, connecting all those pieces together can really give you advantage in sourcing some of these opportunities here. So our sourcing strategy is not just call me when something's listed. It's give me some visibility into the current setup here and owners' pain points, and is there a way we can get on top of that?
Yeah, I think the Kyle hit the nail on the head here with networking is huge in real estate. And I think most people in real estate know that, but the deals that hit public, like everyone sees them. Those are not the best deals. The best deals are private deals before they become public. And so really being able to network with those people, talking to lenders all the time. Believe me, lenders will let you know when they're concerned about a property before, because they want to solve it before it ever goes public. They don't want to deal with foreclosures. They don't want to do that. They just want to solve the
Absolutely.
problem.
Yep.
Uh, broker relationships, these are big ones as well. They're always seeing the market. They know the trends and things like that. Attorneys, especially real estate attorneys, property managers like Kyle Record. But you can also just be looking at the public records yourself, seeing when they come up. People are not a lot of times looking like that. There's programs out there like CoStar that they
Yeah.
basically always scan in public records and giving you the details and things like that. Maybe maybe you're not using CoStar yourself because that's like a paid subscription to the site, but there's a lot of commercial brokers out there who do pay for that and they have the access. So if you have a great relation with a broker or something like that, they can be looking at CoStar and giving you the most updated data. So you can just see if you can find opportunities, because the people who are looking for they're not going to fall in your lap. these great opportunities. You still got to go out there, do the work, and make sure that you're talking to the right people. But when you're looking for, you talking to these people, like what is like, basically, all right, I found a property here. Okay. So what is, some of the risks as a buyer buying these distressed properties? Okay. So we've been talking about all the good parts about it, but there is some risks involved. Realize they're distressed for a reason. Okay. So a lot of times when you're buying these properties, deferred maintenance is a big one. They're probably going to need a lot of capital expenditures up front, roofs, HVACs, anything like that. They could be even out of code. All right. So things like that. There's going to probably need to be a lot of tenant improvements. You're buying a property that's distressed, whatever is in wherever the tenant is actually staying, probably is looking pretty bad. It needs some immediate tenant improvements. Okay. When you buy a property taxes get reassessed. Okay. So sometimes properties, will get triggered a new assessment, and in the market we are now, it could actually increase property taxes. So you want to make sure that you don't have any unexpected consequences. Insurance costs, again, as they start transferring ownership, really need to understand what is the true insurance cost and where is it going to keep rising. All right. Same with any other operating costs. And then you need to look at your rent roll. All right. Can I improve on that rent roll? Probably need to be on the negative side here and say, hey, rents are probably not going to do as well as I think they'll do, because this is a distressed property. It's going to take time to get back into good favor. And then it's going to take time for the community to even recognize it, because a lot of times if this was an eyesore in the neighborhood or something like that, you slap on some new paint, you might get a little attention, but sometimes it's actually persuading the community that this has changed. Okay, this is a new idea. So there's a lot of things and complexities here. So when you are looking, just realize that you need to understand, all right, I'm buying a distressed property that comes with a lot of risk, and I need to make sure I understand it and still make sure the numbers work. And I'm not just buying a property because I think it's going to be an opportunity, but I actually don't know what the numbers are. So I don't know if it actually really is a good opportunity.
All right, let's close this out of here, shall we, Daniel? I think in summary here, what we're trying to get, what we've been covering is we've seen some, and I expected to continue distressed opportunities increasing in 2026. But it's really around that kind of selective surge. And then, so it's a good time to really be positioning as real estate investors, trying to increase our portfolio, positioning on the relationships, understanding the current environment in regards to loan maturities, refinances, all that good stuff. Um, and really identifying the areas to where you feel like you can get a deal and get a distressed property. And, that checks all the boxes we were talking about, and pencil in the current rate environment. So, those are all things to be thinking about right now. It's a conversation we're having a lot in 2026, and I expect to continue. And so keep those things in mind as you're shopping around.
Yeah, don't completely step out of the market. There is opportunities out there. You just need to make sure that you're networking, you're talking to the right people, and you're finding those pressure points. And you might be surprised that there is actually a good deal out there, just waiting for someone to find it. And hopefully that someone is you. Have a good one.